Welcome back to the What's More podcast. I'm your host, Quinton Harris. You're dialed into episode 228. In this episode, I'm going to talk about why I think the Fed is giving us a fake out and what I think is to come for 2025. And it's not just 2 rate cuts. All that and more in this episode at What's Your One More. So welcome back. Yeah, and Happy New Year to all of our audience members here as we kick off 2025. I'm looking forward to a very successful 2025. I'm looking forward to a great transaction count in 2025 for real estate. And I'm looking forward for new prospective home buyers to take advantage of this market and hop into the home of their dreams here for 2025. And why is that going to happen? Well, I think we're going to get some cooperation from the Federal Reserve. And right now, I think we're getting a big old head fake from Jerome Powell and the Federal Reserve Open Market Committee. Matter of fact, I think they tried to play the role of the Grinch that stole Christmas to the markets here by delivering a lump of coal to Wall Street and to the mortgage-backed security market as well as to the bond market. And that's right. They basically did the one thing you never want to do to the markets. And what's that? Tell them something they don't want to hear. And that is, hey, listen, we are not planning on cutting rates more than 2 times going into 2025 throughout the year instead of the anticipated 4, maybe 6. You've heard me forecast 6 to 7 over here. The reality is, I think it's a head fake. I think it is I think it's something that's not 100% accurate. I think the intentions may be there, but I'm going to kick off by saying this. Like, Powell, to me, as well as some of the FOMC members, I mean, they are some of the most arrogant group of individuals just based on mannerisms that I've observed in press conferences as well as meeting one of them. And I'll tell you this, it's a weird dynamic, and I've never seen a group that are in charge of the economy, if you may, and monetary policies be so be like this, right? And it's attention getting, right? And I think what happens is I've witnessed over the last 18, 24 months how much attention can some of these members draw and get, and oftentimes it's saying things that is like creating some sort of stir in the media to get the attention. And I think Powell played the card right to do that, if that's what he was trying to achieve at the podium here after the FOMC. Now, by no means am I saying they're not intelligent, because clearly they have the background, they have the pedigree. But I don't think what they told us at that podium is exactly what's being discussed in that war room. I think this was a head fake. And I think if you look at it from a couple of dynamics, I think there's some politics being played here. Now, go back to the fact that the Fed is supposed to be politically independent. Well, I mean, I could tell you what, I could probably write the script of how this is going to look come February, March, and we'll revisit that. But I'm calling it here now that I don't think we have as strong of an economy going into 2025 as the Federal Reserve wants to portray that we had. And I think that tune may change a little bit as we get into January 6th and a new administration comes in. I think we may see some things change, because here's what's happening. Wall Street, the bond market, everybody was anticipating them to come in there and do the quarter cut. Check, they did that, right? And honestly, when you get that, that should be the talk of the town. That's not what it was. It was the summary of, I believe it was a summary of economic projections for 2025, where the Federal Reserve said, well, we only think we need to do 2 rate cuts going into 2025. And we think that's going to help us fight inflation to get to that target rate of 2%. And Powell was asked over and over again, are you concerned about inflation? Like, absolutely, we're concerned. That's our primary objective, is to get to 2%. Wrong. It's not their problem. Now, again, it's been the mandate, but it's a dual mandate. And the other one has to do with labor. And right now it's labor over inflation. Why? Because the Federal Reserve said, hey, listen, of the 19 voting members, all 19 said if unemployment goes above 4.5%, we're concerned. Now, we don't see it going above that, but we're concerned. Keep in mind, this is the same group that sat up there and told us inflation was transitory. What does that mean? That means that it'll go away as soon as it's temporary. So that same group that was so confident that inflation was transitory, they were so confident that it was temporary, they didn't need to do anything, it would just go away, let it be, was the same group that let inflation go to 9%. It's the same group that neglected that's also saying, we don't think unemployment can get to 4.5. Okay. Well, what happens when that does happen? Because if you go back a couple episodes where we actually did the calculations, it's already over 4.5. Now, it's interesting because of the 19, 14 of the Fed members said, hey, listen, we don't even see it going above 4.3. Well, you're about to see that happen. It's going to happen before the first quarter, and it's going to show up real ugly real fast. Now, my question is, what happens when that happens? What happens when we go above those numbers on unemployment? I keep saying inflation doesn't even matter if unemployment takes away because it's labor over inflation right now. And mind you, right now, what the PCE reading, the Fed's favorite form of inflation, remember that one? Yeah, the core reading came in less than expected, significantly less, and therefore having the year-over-year core with a 2 handle on it. Like, you're already there. We talked about how inflation is going to go up and down and vacillate, but it's not going to rise to 4% overnight. It takes too much of a 12-month average for it to rise that. It also takes too much to bring it down. Powell's term will be over with before they achieve 2% inflation. So something to think about here for me is, okay, let's get rid of all the jargon and the minutia, and let's call it as the BS of inflation, right? Let's get rid of it because it's there. It's going to live around that era of 2.5 to 3.25. We're going to live in that little sweet spot. What's going on with the labor market? And I continue to say there are signs in the labor market of extreme weakness that this economy is not as healthy as Powell wants to stand up there and beat his chest and talk about. We've shown many different cracks in it, but one of the most recent one here was in a report that stemmed and came from Coresight that basically shows retail store closings. Now, here's what's interesting. These are the labor market stats that are coming out. These are places where people are employed, they have jobs, and now all of these stores are being closed. I'm going to read this list off here because it's pretty extensive. These are store closings that are happening right now. Party City, 850 stores. Big Lots, 580 stores. Family Dollar, 700 stores. CVS, 900. Macy's, 65. 65 Macy's stores? Like, how many employees are employed at one Macy's store, and you're shutting down 65 of them? Walgreens, 1,200. Advanced Auto Parts, 727. Rule 21, 543, 7-Eleven's 492, American Freight 353, Conn's 553, DK 249, LL Flooring 213, Foot Locker 124, and Express 105. Like, these are real jobs. That's a lot of people. And yet we live in this strong economy right now, and we're not worried about unemployment. It's not going to get above 14 of the 19 voting members say it's not going to get above 4.3. They're not worried about that. So when I take a look at that, I'm going, okay, what are the real signs here? Like, could we potentially be in a rolling recession in certain areas and not even know it? And by the way, I'm going to have that list and that graph of all those in our YouTube channel at What's Your One More if you want to take a look at that at What's Your One More with the number 1. But the reality is, I think we are in a little bit of a rolling recession in certain parts of the market. And the thing about being in a weakened economy and using the R word as recession around here is that you don't know you're in a recession until you're out of the recession. And I don't think that we're in a soft landing. I don't think they're navigating the plane to get to where it's anywhere near that. I think we're in a worse position than being disclosed. And I think it's easy to stand up there and say, hey, listen, it's great. It's a strengthened economy. The job market's resilient. I mean, if you're a listener to this, I see it on our comments all the time. I see some of you have lost your job. I know what you're going through because I've read your comments on here. And then I also see the statistics out there. I don't know how they don't see that. And so what I'm getting at is I think this is going to happen. I think you're going to have more than 2 rate cuts in 2025. And I'll continue to stand by that because if you look at the dot map, right, that was the big freak out in the market was the dot map. And it was like, okay, well, this is interesting. Why? We did a whole episode on this, and I'll have my producer throw a link to the episode in the show on there. But if you think about the dot map, it's wrong over 60% of the time. It's not wrong, but it's inaccurate 60% of the time, meaning from the quarter in which they previously released it to the next quarter you look at it, oftentimes it doesn't hold true to the projection that was originally on there. It's a moving projection. So just because we get a projection that we don't like as a market, we freaked out over it because we were expecting it to go one way. We were expecting to see at least 4 rate cuts, if not 6, going into 2025, which would stimulate the market. Because we've talked about that. As money becomes cheaper, Wall Street becomes intoxicated by that because they can do more things, create new facilities, new products, cheaper money, more jobs. The list goes on and on and on. Well, Powell stood up there and said, we're nowhere near restrictive territory anymore. I'm thinking, yeah, you absolutely are. You're above neutral in the interest rate. You're still in restricted territory because right now, you could argue that money's easy to get. I've heard someone make that argument, and I don't necessarily agree with it, but it was a reasonable argument, but I don't think it's easy to get. I still think you're in restrictive territory. It's not loosened. It's loosening, but it's not loosened up. And I think one of the things that are going to happen is I think the Federal Reserve is eventually not only going to make those cuts, but they're going to do what they do best and go back to old habits because they die hard, and that's going back into quantitative easing. I do think we'll see QE in 2025. And the quantitative easing is the Federal Reserve stopping the balance sheet runoff and buying treasuries and buying back mortgage-backed securities. And the reason that's important is because for the markets, mainly the mortgage market, right? And the health of that mortgage market, we need that big buyer back into the market to help out, to buy the treasuries, to buy the mortgage-backed securities, because it's been gone for so long. And that's another reason we're seeing rates elevated more than they should be. And I do believe housing is on the agenda. You may have listened to that episode we did with Lenny Curry and one of our guests on the show here. Katie essentially said, hey, listen, housing is on the agenda. And I think that is important because Trump is a real estate background individual. And I think that he also wants to see a thriving economy. And I think he associates the economy with the stock market, the Dow, et cetera, and housing. Those things need to thrive to have that strong economy. And right now, that is not happening in the form of bad news from the Federal Reserve when they come in and they say, oh, we only see 2 rate cuts on the year. We don't see any more than that. We don't need to do that. Again, that's that head fake. That's just being completely off the radar of telling the truth here. And Powell has been guilty of this over the last year. Powell has gone up there, said things, and then his cohorts, his counterparts, the other 19 members will come out in a statement probably a week from now or 2 years from now and say something completely different that hints towards, well, we could see more than 2. And then the markets will react because there's hope and it'll come back. And then we'll play this back and forth game of good cop, bad cop between the Federal Reserve members. And it happens way too much at this point. And this need to be relevant and important in front of the media is getting a little obnoxious here, because if you would just come out, be straightforward and say, hey, listen, this is the rules of engagement. This is where we are. And this is how we're going to fix it, or this is why we're doing well, and we don't need to fix anything. We just need to stay the course. As long as it lined up with the status quo and all the data, that would make sense. But right now, that's not the case. If some of the stuff we're talking about on the podcast interests you, and you're like, hey, Q, I want to be a homeowner. I want to buy an investment property. I want strategies on how I can take advantage of the market. I have a solution for you. And that solution is Loan People, to where it's all about the people getting the loan and the people doing the loan. You guys know me by now. I've been doing this podcast for years, but I've been in the mortgage business for 23. And it's very rare you can find a company that has a mantra for loan officers, by loan officers. And what does that mean? That means you have a company that's designed to help provide the best atmosphere for loan officers possibly imagined. And not only that, the most efficient operations for those loan officers to be successful, which provides a better customer service. And that's what you get at Loan People. So much so that they put that in the company name. And at the heart of this is the people. It's in-house processing, it's underwriting, it's closing and funding. And why choose them? They got great rates. They close on time and they have award-winning service. So check them out at loanpeoplejacks.com. That's loanpeoplejacks.com. We get these job reports and they come out and you see, oh my goodness, there's this number that's reported and it beats expectations, and a month later it's revised all the way down again. How can that continue to happen, right? And we've talked about those numbers and how far off they are. And even some of the ADP revisions that are happening right now in the private job sector, it's continuing to be a sign of a joke at this point. But when you look at that unemployment number, I'll continue to dance on this all episode on there. Do you recall last quarter, they talked about what was the number that scared them or concerned them that they would need to do rate cuts? They said it was 4.1. At the time when they said that, unemployment was at 3.8. And we said on the show, if that number gets to 4.1, you can bet more rate cuts are coming. Well, at the time when we did that, the next month it jumped to 4%. And then the following month it jumped to 4.2. And rate cuts were happening. And they happened way more than just 2. And I think right now on the next BLS report, we may see that 4.3 number. And if we don't see it on this one, we will darn sure see it on the following one. I think you might even have your first 2 rate cuts by Q2, maybe even more than that going into the tail end of Q2. I don't think for one second that they're going to sit back and say, okay, you know what? We're just going to pause here going into the next meeting because we think things are going the right direction. And, we're just going to keep it at this restrictive territory in order to do what? To get inflation to 2. If that's your stance, if you're going to the podium or you're going to the American people and you're saying, hey, listen, the reason we're doing this is because we have to get inflation to 2. Think about how ridiculous that sounds, because there's nothing you can do in that 1 6-week cycle to get it to 2, because it's a 12-month moving average. That's not how that works. And we just saw how restrictive you were for 18 months, and you got it down, and you've got it down to a point that already has the 2 handle on it. Why continue to choke the life out of the economy because you want it to get to 2 for what? I mean, what? So you can say you did that? We're already there. I think more importantly, if that runaway train of unemployment starts going, that's going to be a bad sign, because if you keep it so restrictive where employers are going, you know what, we're not going to hire right now, or, better yet, the lag time to obtain a new job right now continues to grow and get worse and worse and worse. That's not a good plan either. I could pull up a statistic here. I thought this was interesting. I'm going to move around my laptop here and pull this up, because I think what we saw is that we're seeing the time in which it takes to obtain a new job has gotten to a much higher rate than a lot of people are comfortable with. For example, the median duration of unemployment has been on the rise and is the highest level since 2021. Let that sit in for a minute. The median duration of unemployment has been on the rise and is at the highest levels since 2021. 10 and a half weeks to obtain a job. So let's just call it 11. That's basically 3 months. 3 months to obtain a new job. That's up 21% in just the last 7 months alone. And that is also going with the continuing claims. Remember, those are people that are continuing to get unemployment. That's at almost 2 million people. That's the highest level since 2021. What else was going on in 2021? Yeah, that we all know. Rhetorical question, right? COVID, right? We knew we had record high unemployment levels and record high employment claims. But what we also had here is the highest time it took to replace a job and go find another job. This is interesting here, because I think that's a sign that, oh, hey, things aren't as great as you think they are right now. And again, as it's becoming increasingly harder to find a job, I think with some of these additional closures that we're seeing, I think, again, the duration to find the job, you can start seeing that unemployment rate tick up in Q1. I think it's going to go over that 4.3. I'm not saying it's going to jump to 4 or 5, but I think it's going to go up. And I also think that's going to help rates. I also think that's going to apply pressure to the FOMC to stand by further rate cuts, not just the 2. I also think you're going to see QE come back this year as well, which is also something that's been gone, disappeared from the market for quite some time. So all of these things adding up, I do forecast and I do see more than 2 rate cuts. I'm going to stand by the additional 6 that I've called for, because we've already got the first 2 bullets are down. So we got 6 more to go. I called for 8 back in October. I still think that's going to happen. And I think there's ample reason why in this market here. So let's stay tuned. Let's take a look at it here. But at the end of the day, the head fake, I'm not buying it. So until the next episode, if you like what you're hearing, please share this episode, 5-star review this podcast on Apple or Spotify. Check us out on our YouTube channel at What's Your One More. Subscribe, leave your comments in the bottom there. I promise you we'll respond, whether on air or back to you on the show there. Till the next episode, we'll see you at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.